All right. What's up, guys? I hope you're doing well. James here from jamesdforsythe.com. So I've just been looking more into possible effects of bank runs if a CBDC were to be implemented, right? Because there's a lot. It's one of the bigger concerns of central banks, right? If they implement such a CBDC, is how will it interact with the current system? And I've done a few videos on the interoperability of the system, the currency itself, and so on. Um, but I kind of wanted to go more in depth with some actual charts and I think a table as well about how would this affect on possible bank runs, right? So even in benign conditions, um, it's kind of shaky exactly what a CBDC would do. But during a crisis period, could it be considered like a safe haven? Um, and that's kind of the whole selling point in a way of the central banks is that their CBDC would be like the safest form of money, right, for people. Their words, not mine, right? And so essentially, would this make bank deposits or especially uninsured deposits um, to be perceived as more risky? And then basically, people would just get out of them and go run on to a CBDC. What would that do to the underlying system, right? Um, so, with that being said, with the introduction of a CBDC or certain new forms of private money, would this increase the risk and stress? The risk being a run on banks by providing an easily accessible recourse to a safe asset. Although the specific mechanics of any run would be impacted by the legal and operational design of the CBDC. It's handling by banks or other financial service providers, right? So, kind of what I was already saying. And hold on a second, I forgot to do the screen share. Anyways, here it is. Okay, so again, PDF from the series of papers that is a collaboration of multiple central banks in the BIS. Back to it. Okay, so and to give some examples, right? So basically, there was a financial crisis in Japan that erupted in the late 1990s. And they said it took about a week or so for the deposits of the failed banks to fall by 10%, kind of showing somewhat of a bank run. And the data is here in this table. And so we see the different banks, day of announcement, um, the, the deposits. But really, what we want is the outflow deposits in this percentage part to see it, right? And so you can see for each individual bank, after the first month, I mean, it was a lot more than 10%, but they're only talking about the first week, it seems. And even then, maybe they're talking about an average, but even then, maybe it's not. Maybe that's an aggregate total, and they're just showing the worst ones here. Because, see, it took a week or so for the deposits of failed banks to fall 10%. But when you go into the actual table, it looks like the outflow deposits, like here's one where it's 15%, here's 19%, 23%. And so it's like, where are you getting this number from? Sort of thing. Um, and then after the first month, it's even worse, where one of them was up to 30 and 32% of an outflow, right? Which is kind of much more on par with their Greek example that they give here. And so basically, in call it Brexit, I'm not all too familiar with European politics and the history behind that, to be honest. Um, but anyways, so the deposits at Greek banks fell in total by just over 30% and about 25% respectively from 2010 to 2012 and then 2014 to 2016. And you can see this in this graph here. And so it's pretty much you have the overnight, I'm assuming overnight deposits, and then deposits redeemable at notice. So I guess it's like a demand deposit, and then you have time deposits and cash, right? So one thing I noticed is there's like no demand deposits at all. Like I think I kind of see a sliver here, but that's it. Let me move that out of the way, and that didn't work. I tried to zoom in and it jumped on me. Yeah, you can kind of see it. It seems. But that's all you got, and then it's mostly cash. But one thing to notice is you see in 2009-ish, at the end of it, all the way down here, it goes from about 200, I'm assuming million, all the way down, or 200,000 million, my bad, um, all the way down to like 130-ish. And so you're looking at significant decline, right? Um, yeah, and in all type of deposits too, at least on aggregate total from 2009. And so you see kind of them start to increase in terms of the overnight and the time deposits, whereas cash is just kind of staying the same. And so beyond banks, it is possible that CBDCs could be a substitute for investments in other low risk assets, liquid assets such as money market funds, treasury bills, leading to abrupt shifts in their funding. So this is where I'm talking about um, significant changes in like where it could potentially destroy the system, right? Because if you're going to be taking out liquidity of the treasury market or money markets in general. I mean, like even just the repo market, that's essentially like the financial system, right? If the repo market spikes or if the repo rate spikes, sorry, and basically there's a liquidity freeze in there, things start falling apart like immediately. And that's essentially what happened with, I believe it was August 9th, 2008. It was technically the start of the GFC with basically liquidity freezing up in the repo market and the shadow banking system just falling apart, right? And that's really what it was about, not necessarily just subprime lending, right? And so, depending on, to go back to CBDCs in general, so depending on its design features and relative remuneration, introduction of a CBDC could be an attractive alternative for some risk-averse holders of other cash substitutes, even in benign conditions. And so the extent of this demand is also likely to be contained if CBDC is restricted to retail use, right? So basically, and we've talked a little bit about this in the past, to like who exactly should be allowed to have CBDC, and not my opinion, this using the discussion papers in which they've published to really talk about that extensively, right? And so, like, who should even be allowed to have it? Should it just be like for payment purposes for individuals or businesses, or could it actually be used as a sort of investment, right? And this is really where the problem of runs on banks could come from, is if it could be viewed as more of an investment, meaning it has a form of interest bearing characteristic, right? And so if it bears interest of it in and of itself, or if some kind of um, financial engineering could be applied to it to make it produce interest or profit in some form, how would that go? It basically just, could you create derivatives off of it in some form, right? And that's basically stuff like that is where this problem comes into, where it could be viewed as a better alternative for people to go to that instead of having just their money in the bank, and all those outflows of deposits going into the CBDC could produce these effects on the financial system as a whole, right? And so large scale money market fund outflows in the GFC and the onset of the pandemic also indicate that a CBDC could increase the risks of runs from non banks in stressed conditions, right? So the critical question is whether and how the introduction of a CBDC would affect the run dynamics in prime money market funds by offering an alternative safe haven other than reallocating funds to government money market funds, right? So basically, would, instead of running treasuries, would they run to the CBDC, right? And so, how would that affect the differences between funding the government or having it more private, right? And so, how exactly would that dynamic go? And that's something very important. So CBDC remuneration and the ability to redeem money market fund shares directly into CBDC without going through the payment system are important considerations. And money market transactions, specifically overnight unsecured deposit transactions, in which money market funds are key participants, are also used to determine interest rate benchmarks, such as SONIA and EONIA, as we have seen in the past with LIBOR. The integrity of indices, which matter for financial market functioning, requires sufficient transaction volumes in underlying markets. If you don't really understand exactly what that last sentence was kind of about with the LIBOR and mostly with requiring sufficient transaction volumes, that was one of the reasons why in the with how LIBOR was calculated with the waterfall mythology, there were so many level three submissions for LIBOR in general, right? It was because there wasn't enough transaction volume for them to derive it off of incoming data and even historical data in some degrees, and for some currency tenor pairs. And so, therefore, you would basically have level three expert based submissions be the only alternative, right? And so that was mostly for the non-USD, if I remember off the top of my head. Um, I will link and I will put in a end screen here for you guys the LIBOR video and post. Well, they're both linked together, so you can, if you want to read it or watch a video about it, and me explaining it either way, kind of what I'm talking about with that, and I actually show the waterfall mythology, breaking it apart in the levels, and then also going explicitly into, I think I used US dollar, the USD tenor pairs to explicitly talk about it, to where it's basically showing, okay, this is the proportion of level one submissions, level two, level three, and so on. And as always, I link the source to it so that you could look at all of the tenor currency pairs as well. So I'll put that in there too. And also, as always, if you're interested, make sure you watch some of the other central bank digital currency videos. Love to get more input on those. Because a lot of the times in a lot of these videos, it's just me kind of going over the data and stuff. I try not to place too much of my own biases in them or kind of my own views originally, especially in the few ones, or in the first few ones, I should say. But after I've read and studied it for quite a bit and get more of an understanding of basically all of it, um, not only just the central bank's kind of opinion of it, but mostly just the topic in general. Then I start to kind of craft my own opinions around that. I'm not a very opinionated person. I'm more interested in trying to understand a concept from every point of view I can think of before I really start to be like, I think this about it, right? And the CBDCs are obviously getting to that direction because I've done quite a few videos. There's a whole playlist for you guys, so feel free to check it out. But I'm going to leave this one here, so hopefully I'll see you guys on one of the videos I just talked about. And I hope you guys have a good night. And I will see you on the next one as always.